Fixed indexed annuities pay interest a little bit differently than the typical bond or the typical variable annuity or even fixed annuity. First, I'll review the three types of annuities. There's fixed annuities, which basically are like CDs. They pay a fixed rate of interest for a fixed period of time. Occasionally, that interest rate will fluctuate anywhere from right now between 1 and maybe 3%. Variable annuities go up and down with the stock market. They're far more risky. They're sometimes laden with heavy fees. And then there's something kind of in between, which is the fixed index annuity that goes up in value when the market goes up and doesn't go down in value when the market goes down. It locks in profits every year as well. How they pay interest is based on an indexed, a common index. It could be the S&P 500 or the Dow, the 30 stocks in the Dow, the NASDAQ, even some correlate with gold. The way a fixed index annuity pays interest is the company locks in your principal in safe investments such as high-grade corporate bonds or treasuries, and they invest the difference or the interest that they are guaranteed off of those investments, and they bet them against an index. For example, the 2 or 3 or 4% that they might make on the underlying investment itself is not shared with you. It is actually invested or typically in a hedge form or on options to an index. So if the market goes up, that option or that bet on that index makes money. For that reason, if the indexes perform well, the interest that's made on the underlying investments, the bonds and treasuries typically that the insurance companies park your money in, will make more than the 3 or 4% that they're getting at the coupon rate. That's how index annuities can actually pay more than a fixed annuity. It's also why the principal is guaranteed and why you don't lose money in an indexed annuity, because you're not actually investing in the index. If it goes down, all you lose is your bet. You only lose the interest that you might have made had you chosen a fixed rate of return. Well, indexed annuities, a fixed indexed annuity is different than indexed investments. Indexed investments, for example, go up and go down. You basically own the market both ways. You own the good and you own the bad. The upside is as high as the market goes. The downside is as low as the market goes. A variable annuity works much the same way. The investments that you put your money into are not protected. They're not parked in safe places like treasuries or high-grade corporate bonds. They're typically placed in mutual funds, typically growth funds or balanced funds, whatever type of investment that you want to make, but you're subject to the ups and downs of that particular market. So if the market goes down 50%, you could lose 50% or 20 or 30%. In fact, you could even lose more if you have more aggressive funds or sub-accounts in that variable annuity. I'll just give you one example. In 2008 and 2009, the typical variable annuity that I've reviewed in the last few years went down somewhere between 30 and 50%. So it tracked the market pretty closely. As the market has come back, many of those sub-accounts went a little bit conservative and got out of the market, and so a lot of those accounts have not come back even as much as the stock market has. I mean, we're knocking on the door of the old highs. In other words, we've had almost 100% rate of return over the last few years as the market's recovered. Most investors aren't back to even. If you would have had an indexed annuity back in 2008, when the market fell, you would not have lost a dime. The next year when the market came back 30 to 50%, clients made anywhere from about 5 to 20% of that upswing. Having not lost anything beforehand and having made somewhere between 5 and 20% that first year on the rebound, many investors are obviously very happy. The best part is they never had to go through the stress and the gut ache of riding that investment to the downside and having to wait for it to come back. And consequently, since the market bottomed out, every investor in an indexed annuity I know has made money. And every investor I know that had an indexed annuity before the market crashed did not lose money.